Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is July 26th edition of Market Outlook. Don't forget to sign up for this, free, and receive this in your inbox every week by going to www.marketgauge.com. All right, so last week, as we pointed out, market was running a bit rich. Looks like we gave up just about all those gains, and in some cases, even more so as we get into the Dow, which has more exposure to the global economic conditions than any other index. So without further ado, let's get into some of the details. NASDAQ 100 leading stocks. Interesting, even with Amazon up at one point over 20%, whoops, up 8 or 9 billion for Jeff Bezos, CEO, and only up 4 billion. So depending on how you look at it, certainly a good day, or gee, I lost 4 billion from the equity highs on the gap opening in Amazon. But nonetheless, taking a look at the charts, we had pointed out that we were at the top end of a Bollinger Band and looking a bit overbought. We did manage to sell off almost 3% for the week in spite of that blowout performance by Amazon. Where are we? We're back into support right at the breakout line. So on the cap weighted index, really haven't broken down, looking still that it broke down and held support at this point. However, taking a look at the average weighted index, quite a bit of a difference. We clearly never took out the old highs. This is the NASDAQ 100, but calculated a different way, and broke down even more sharply because of the lack of breadth in the market, and the average stock went down quite a bit, 1.25%, which means we broke down under the 50-day moving average. Have we been breaching back and forth or around it? Yes. So it makes it less critical. Again, the most important moving average here on the chart is the 200. But meanwhile, this pattern here, as it keeps on dragging out, looks more and more ominous. Now, one thing in its favor is that you are at pretty oversold levels. Look at the RSI here, down at 1.44. At 3, it's oversold, so we're clearly at that point. Does it mean we can't get more oversold? Absolutely not. Again, look at the 43.30 level to 43.60 or so. That is your support here, and also against those recent lows. Take a look at the Dow. That is clearly the underperformer, and actually we got a close under, on a weekly basis, under the 200-day moving average. So not only did the Dow fail to take out its high, and in fact it didn't even breach its most recent high in June on that rally in July, but now we're breaking down fairly sharply, and it basically is just about equivalent on a closing basis to where the lows were from just a couple of weeks ago after the Greek crisis. So not looking good there. SPY, sort of in the middle between the two indices. Clearly, we broke down under the 50-day moving average. We gave back pretty much all of the gains since the Greek crisis was temporarily resolved. We had that breakaway gap, and guess what? Filled here this Friday. So again, watching this 200-day moving average, I would expect some sort of bounce. Maybe they paint the tape, penetrate through it, but again, we're at an oversold condition already. So in the next couple of days, if we persist with some more pressure, we are ripe for a bounce. at least on a short-term basis. Uh, on the other hand, the market is looking quite heavy, and the Dow chart really tells the picture. I want to go back to the Dow and also take a look at the weekly charts as well. So our long-term chart on the Dow being held intact. This is a 65-week moving average, this blue line. We're holding it here. So we would look to find some level of support. Again, close under that 65-week moving average would be extremely significant. Look how well this moving average is held, and it's really been a great pivotal point. You did have one penetration back in the mid part of 2012 and quickly reversed. Again, this has been a key moving average across the board. We do get some penetrations. We've only had a few of them on some of those corrections, including the sharp one in 2014, but ended up closing the week above it. So we are looking quite heavy here in the Dow, but you have to say that the longer term trend based on the weekly charts at this point is still intact, but we clearly want to watch a penetration through it and a confirmation with price closing under it for at least a week or two, and that would indicate certainly a change in trend. But nonetheless, keep an eye on this 65-week moving average on the Dow. That is the weakest index. If that's the first one to go, we want to definitely be in touch with that. So that is important. If we take a look at IWM, which is sort of a more broader based index, trading a bit above that 65 week as well, but going to the overall chart here, the daily chart on IWM, look at this. This is a new low close in the last several months. So the interesting, the index of smaller to mid-cap companies under a lot of pressure, not quite as weak as the Dow, but still under pressure. And again, that was our index that we were most optimistic about, right? We had all this sideways action for most of 2014, broke out above it, had to sell off, another rally when NASDAQ made new highs last week, couldn't follow through at all and failed, and now has closed lower. So lots of short-term pressure on the markets. It'll be interesting to see if the weekly charts and those longer-term moving averages, which is the indication of the overall longer-term trend of the markets, stays intact. Taking a look at some of the market internals, you can see the one of the bull markets around in any instrument is that volatility is dropping. So along with the markets looking heavy along this sideways action within a longer term bull move, you've got this interesting setup where volatility on an absolute basis is extremely low. Taking a look at VXX, you can see we have just continually drifted lower. Now granted, this is a ETF that has tracking issues, but XIV does not, and you can see XIV on a weekly basis also pretty much, if you go back for years, at lows, volatility at absolute lows. This works inversely to it. So overall, sort of an anomaly with the market acting as heavy as it is at the highs, that volatility would not have spurted up, and as a result, since this works inversely, you had a pretty incredible run, a sell-off, and again attacking the highs of this instrument, meaning volatility reaching about the lowest level in many, many years. Now, taking a look at the volatility ratio, which I think is probably a better indicator overall of sentiment, you can see, as I had pointed out last week, and we were particularly cautious about the new highs that were set by NASDAQ by only a few leading stocks, that the volatility really got extremely optimistic here. We hit overbought, and it's been coming off. And as you can see, that there's plenty more room to the downside here. And I would put sentiment as working off its overbought readings and being overly optimistic, or as Greenspan might say, irrational exuberance. Let's take a look at some of the other market internals. McClellan oscillator also got just a hair under where it gets overbought and has sold off, but not yet reached oversold territory. So more room on the downside for the market internals. Looking at the advanced decline and obviously the up-down volume, there's more room as this thing is still propelling down. And on the sentiment, same type of issue, still working relatively overbought readings. Taking a look at bonds, with all of this going on in the markets and the testiness there at the new highs, it's not surprising that there has been pretty good movement into treasuries here. And these are long-term bonds. As you can see, we move back up over the 50-day moving average. Slope seems to be turning up. We did get a bit overdone here, touching near the bottom of the lower Bollinger Band, but overall the trend is should find some resistance around the 124, the 125 level near that 200-day moving average. So interesting, even with Yellen saying she's going to raise rates, and that seems to be definitively in the cards, the market is definitely reacting in a interesting way here, with rates abating after that pretty sharp rise. So sort of a mixed message from the market. Now the other thing to get into is GLD, gold. Very interesting pattern. This is from what I've seen over the weekend in terms of research. Hedge funds now are short the gold market in large enough numbers that they're actually net short gold, which is like one of the first times that's happened on record. Now, interesting, as we've had a pretty good size drop, a drop over the last 2 to 3 weeks of almost 10%, on the daily chart we have a key reversal pattern. So with all the hedge funds short or out of the market, this pattern is particularly interesting. This is a key reversal bottom pattern. Now the other thing that's also of interest, let me is the volume and the range. So you had really very, very high relative volume. And normally we trade somewhere around 5.5 million shares. We traded up over 11 million. So we had double the normal volume, which is sort of a threshold for what I would consider a blow-off bottom at what, with multi-year lows and an extended range. So with all the hedge funds trapped here, potentially trapped, it'll be interesting to see what happens with the gold market, and if this key reversal pattern here, this is called the bullish engulfing pattern. It's classic. It opens up lower on a gap down. The lows are basically put in the morning, closes on the highs, engulfing the past day or several days, which it has. That is considered a classic bullish engulfing pattern, and for us, what I would call a glass bottom type formation. right? And so let's see if that plays out. Looking for some more follow through, and maybe with all the noise, all the flush is out of the market. Uh, but very, very interesting pattern in conjunction with what's happening with the interest rates as well. So, of course, higher rates would mean more pressure on the gold. On the other hand, it's probably, you know, baked in here. And interesting, even though rates are set to move higher, as set by the Fed, the actual bond market rallied and put downward pressure on yields. So, sort of a mixed message here. Going through a couple of other things, let's take a look at Greece, GREK. And as I mentioned, everybody, was ecstatic. A lot of the stock markets moved up, except for Greece. So since the announcement, Greece has basically traded sideways to down, and it's basically sitting on the lows. On Friday, it was down almost 3% alone, and not quite the lowest close, but not looking pretty at all. So Greece stock market not really looking like a terrific bailout. The terms are too stiff, and the Greek economy still under tremendous or even much bigger pressure than it was before the whole crisis unfolded the way it did. Now, let's take a look at a couple of other things here. We're going to look at calendar ranges on the SPYs. So, as you can see, we have a couple of things. The heavy green line is the 6-month calendar range. New one has been set. So, the higher the range, the lower the 6-month range, and this is the July range. So on Friday, we managed to close beneath the high of the July monthly calendar, and we also broke through the highs in the last couple days of the 6-month calendar range, which is significant. So important support comes in around the 204 level. That would break the 6-month calendar range, and that would be really a first on a closing basis since last October. And you can see what happened there. We had a pretty nasty sell-off, and still overall the pattern then reasserted itself, but clearly under pressure here. What we definitely want to keep an eye on is a bounce potentially off of these lows that were put in this week, and a reversal and a move above the 211.50 level, which would then basically take out the 6-month calendar range. So for now, more pressure indicated based on another type of indication, the calendar ranges. Just another thing to note, here's a page of all commodity related products. So we have gold, silver, corn, all of these. The only commodity that's showing any type of relative strength being above its 20-week moving average, which is that cyan line. As you can see, looking at all of them, DBA, USO, oil under pressure, all of the commodities, sugar, copper, energy over here, every single commodity under pressure and really attacking or at or making new lows. So we're going to keep our eyes on the commodities here, the softs, as well as oil and gold. And interesting to watch that gold pattern, because that may be a clue that these are washed out as well if gold can bounce here. One last thing, let's take a look at some of the weekly ratios. Another thing that is a bit disconcerting is the fact that a lot of the sectors are continuing to be heavy and breaking down. IYT, you can see we're trading under the moving average, sharply down here. Transportation still under extreme amount of pressure and moving to the downside. Now, looking at the leading indexes, there's only three of them that are really doing very, very well, or four out of the 12 or so that we look at. So, interesting, taking a look at Cure, which is in the healthcare, we're still above our sharply rising moving average here of the ratio on a weekly basis, but attacking it and moving to where the all-time breakout was. So if we fail here, that's a leading that's a leading sector that is definitely going to be under pressure. Again, similar type situation in IBB, which is biotech, which has been on fire. We had a nasty correction based on earnings. So while Amazon pushing NASDAQ higher, almost up 20% on the opening, only closing up 9 or 10% by the close, you had pressure in the biotech stocks, and they got crushed, which ended up putting pressure on the NASDAQ index. But one of the key components, biotech stocks, still very, very strong. So you got Cure, and IBB, both in the healthcare and biotech area, looking pretty good. But let's keep an eye on that. The other leading one right now is XLF. It acted okay on an absolute basis, not that strong, but over the last 6 months or so, certainly one of the better performing ETFs in terms of sector measurements. So you got the financial sector, the healthcare sector, still the leading sectors in the market. Meanwhile, all the others really under pressure and not looking good at all. So that's one of the other things we look at when we lose leadership and a lot of the sectors start breaking down. That is a good indication that the market is giving way. So right now we have 3 or 4 positive sectors. If that drops down to only 2 or less, we're going to be much more concerned about the market. All right, well, that's it for now. Hope it helps. See you next week, and bye for now.